Guðmundur Pálmason. I'm the CEO of Strax AB. I have been with Strax now for 18 years in various different functions. I have been the Chief Financial Officer of the company. I've been the Legal Counsel. I'm a lawyer by education. And I've been a director as well. And since 2008, I've been the Group Managing Director. I'm not sure how you want to run the presentation. If you have questions during the presentation, I'm fine to take them during the presentation and also afterwards if you desire. So what is Strax? We are a global company and we specialize in mobile accessories and connected devices. And before I go into the presentation, I just want to show you what I mean with mobile accessories. So on my phone, so we have products that go and either protect your phone like a cover. I have on my screen a screen protector. So these are typical categories in the mobile accessory space. One of the three largest categories is actually protection. We have then audio, which is headphones and Bluetooth speakers, also representing roughly 30% of the category. And then the last key category in mobile accessories is power products, chargers, cables, everything you need to keep your mobile phone up and running throughout the day and even longer if needed. So these are sort of the basic accessory categories we deal in on a daily basis. And just to put into perspective sort of the size and scale of Strax, in 2016, revenue is roughly 90 million euros. Our trailing 12-month revenue is 98 million euros. In terms of number of products sold, in 2016, we sold 17 million products, of which we manufactured ourselves roughly 14 million. And we have manufacturing partners in Asia. We don't have any manufacturing capacity ourselves, but we rely on factories in China first and foremost. Connected devices, this is a new category in significant growth. These are wearables like fitness trackers. These are smartwatches. These can be what they call hearables that have now all kinds of different functions. You have a heartbeat monitor and smart functionality built into hearables. These are our smart home devices and various different accessories. And why we are also focused on connected devices is this is connected usually through your mobile device, whether it's a tablet or your smartphone. So that's why this is a natural category for Strax to go in. So we are what we call a house of brands. We own 6 brands ourselves. We have 3 licensed brands, and then we work as a distributor for 30 to 40 brands. So I want to correct in the beginning, we are not a typical distributor because the majority of our revenue is coming from our own brand. It's important we keep this distinction that a distributor is a certain type of legal entity of which we serve a distribution function, but the main part of the business is to manage the brands that we own and control through licensing agreements. So what do we do for our retail partners? So we ensure that they maximize the revenues and profitability from these 2 categories. Examples of retail customers, just to again give you some perspective of who we sell to. If you go here on Kungsgatan, you can go into a Telia, you can go into a Tele2, you will find multiple of our brands, both the brands we own, the licensed brands we control, and some of the brands we distribute. And then also into El Gigante, you will also find multiple brands from ourselves. So we sell to these key retailers in the mobile accessory and connected devices space. The company's been around for 20 years. This has been a continuous evolution. We started out as a trading company, basically, evolved into a distributor, and from there into a value-added distributor. And the positioning now is what we call a house of brands. The most notable facts here, we listed the company in 2016 on the Nasdaq stock exchange. And the other fundamental thing I want to highlight here is in the last 12 years, we have executed 8 acquisitions. So that is one of the core components in our growth strategy is acquisitions, and I will talk about that a little bit later on. Key numbers, I told you, trailing 12-month revenue, 98 million euros roughly. We have 200 employees. We have 12 sales offices scattered around the world. And as you see here, 17 million units sold in 2016. One of the core strengths of Strax as a company is our customer base. And if you look at the Telias of the world, the telecom operators, which still play a significant role in the value chain of mobile devices and smartphones and therefore accessories, we are dealing with close to 50 global telcos. And if you look at some of the competition we have, it's very unusual if a single competitor has more than 10 direct telecom operators as customers. So in terms of the strength of the customer base, this sets us apart largely from the competition. Our value proposition, I always say we do 360 degrees mobile accessories. So everything in the category we do, and why not 360 if we don't do manufacturing. In terms of the value add in the total mobile accessory and connected device space, the value add coming from core manufacturing is very limited. But everything beyond that, Strax touches in one way or the other. Of course, customer relationships differ from one to the other, but we can, from managing everything from product development through manufacturing, through distribution, and ensuring that the products will sell through the retail outlets, or we can source an individual product and deliver that into a centralized warehouse of that particular customer. So it's a very broad and quite modular platform we have built in the last few years. This is where we operate out of. We have our main office is out of Germany, where we have our distribution center for Europe and carry out some of the back office functions on a group level. You see two dots in Asia. We have a buying office in Hong Kong, and then a quality control and quality assurance office in Shenzhen, where we have also light development work and project management for ourselves as well as some of our key customers. A key growth market for us this year and going forward will obviously be the US and Canada. If you look at our core business in 2016, we generated roughly 85% of revenue in Western Europe, 10% in the US, and 5% the rest of the world. We believe that this mix will change, and sort of 3-4 years down the road, that the revenue distribution will be quite balanced between Americas, what we call Western Europe, and rest of the world. So we are focusing and investing heavily in both Americas as well as some of the international markets. Back to mobile accessories, we briefly talked about this one before. The key categories being protection, power, and audio. The market itself, it's a very big market, as you can tell, $134 billion by 2021. And so we are literally a small fish in a very large pond. And what's worth mentioning here is that there is a correlation between smartphone sales and accessory sales, but they're not correlated one-to-one. Meaning, we have seen in Western Europe the smartphone growth stagnate in the last 2-3 years. At the same time, we've seen accessories grow considerably. There are two reasons for that. One is that people are buying more accessories per single smartphone. 2 years ago, power banks didn't exist as a category. And this is one of the fastest growing categories now. 3 years ago, the screen protector category didn't exist. So people are now, rather than getting a case, they're buying case and a screen protection to prevent the €300 or $300 screen from breaking. You can do that investment for 10 to 20 euros. So that's why it's growing quite rapidly. The other reason why the accessory market is outgrowing the smartphone market in value is the average selling price per accessory is growing. So meaning the average selling price of an accessory has gone from, at a retail level, from 15 to 17, well over 20 euros in Western Europe. And we've seen the same developments in other sort of developed markets. We own 6 brands, of which 4 we have launched ourselves. Own brands represented last year 64% of our revenue. We have acquired 2 brands in the last 3 years. We acquired Urbanista, which is a Swedish-based audio brand. It is by volume, it's the highest selling brand in the Nordics. And we've had a very good success with that now in the UK. You find that in the Dixon's travel stores at every airport in the UK, for example. And lately we're getting great interest out of the US. Gear 4 is another acquisition we executed 2 years ago. Also very successful brand. It is the largest brand in protection in the UK, both in terms of value. They're fairly expensive covers. They cover from Gear 4, average retail price is £35, and it's the largest both in value and volume in cases in the UK. And again, also we're getting great traction in the US with Gear 4. But all these brands are quite important for our strategy going forward. What's important to understand why Strax is not a distributor anymore. When we sell, for example, a Gear 4 or Urbanista in the US, we don't use Strax as a distributor in the US market. We have local partners that take on the distribution role. And from an operational leverage point of view, this is critical to understand that the incremental revenue for us in some of the new markets we're investing in is very close to zero. Yes, we might need a new key account manager to support a big distributor in any given market, but we don't have to invest in warehouse capacity, we don't have to invest in warehouse people, or systems, or infrastructure. So that's what sets us apart from a pure-based distributor, is that we are a product company, and yes, we offer distribution services in certain markets in Europe. So that the distinction is quite important for us. We have licensing agreements with globally known brands. So we have 2 license agreements currently, one with Adidas and another one with a German-based fashion brand called Bugatti. This is not the Bugatti car, by the way, but still it's a pretty well-known brand in the DACH region. Why is it important to have these licensing agreements? This opens doors for us. In a market where you see commoditization happening in certain product categories, if you have something unique and different that nobody else can offer, you open doors. And you can also sustain price with a unique and differentiated product. So that's why it's super important to have these licenses. And again, talking about the value of the licensing business, last year for Strax, licensed products represented roughly 4% of our total revenue last year. How we position the brands, and you might ask yourself, why do you need all these brands? Why don't you just have one? Isn't it easier to manage a simpler assortment of products? Isn't it from an inventory control, forecasting control, planning, etc., easier? Yes, but it's very challenging to have one brand that is operating in multiple different types of retailers. So if we would, as an example, take Gear 4 and sell Gear 4 in a supermarket, we couldn't expect the Telias of the world to list that product as well. That's why we have to have a differentiated product proposition to be able to target various different type of retailers. So that's sort of the reason why we've launched more than one brand. And then on the right side, you see some of the brands we work with. We work with all the most notable accessory brands and OEM brands in the business. So we do Samsung, we do a little bit of Apple where our customers need. We do LG and all the big OEMs, and then some of the better known accessory brands as well. Connected devices, again, you see some of the examples of connected devices, smart home products, wearables, smartwatch, fitness tracker, and a drone. These are sort of the typical categories in the industry. This industry in itself is in its very infancy, just starting. Everybody knows it's going to be big. Nobody can tell us which brands or what product categories are going to be big, but it's going to be big. Even the number or the quote I have up here, which is from Ericsson in Sweden as of last year, talking about the number of connected devices, saying connected devices will be 20 billion by 2021. I attended a seminar in London 2 days ago, and they've upped their forecast, Ericsson has, and they're now talking about more than 50 billion connected devices by 2020. So not only have they increased the number of connected devices, but also they pulled in the date in terms of its significance. And these are, of course, I'm not going to stand here and tell you these are all smartwatches. These are largely sensors that will be attached to just about everything in the future. They're getting smaller and smaller, and are having better battery life than in the past. But this is an important category for us to be relevant in, because many of our customers that are buying accessories from us, they are asking us to support them with connected devices. In many organizations, these are the same buying teams that are dealing in these two product categories. That's why we don't have to, again, build a new sales force to start selling connected devices. We have not yet launched our own brand in connected devices, but that is sort of the next natural progression for Strax. We've undertaken a few development projects and won awards for those. So last year, for example, which you see here, is we launched a VR headset for Orange, a group in France, and all of their Orange branded telcos in Europe. That sold extremely well and it got good reviews from the markets. We have developed second generation of that, this VR headset, and we also developed an ecosystem of products around it. So there's a VR gun and a few other sort of gaming devices to go along with that product. It's not a complicated product. It doesn't have any internal components. This is sort of a dummy VR goggle, but nevertheless still falls within that category. One thing to point out, Strax is not going to invest and build categories. We want to utilize our supplier base in Asia and be very fast in following when we see a trend becoming more than a trend and hitting the masses. We want to be able to go to our supplier base, quickly copy, improve a product that is getting traction and launch that into our retail partners. So R&D is not going to be a big part of our P&L and balance sheet going forward. Some of the customers we have, I mentioned a few earlier. You see a lot of telecom operators, Telenor, Tre, Telia, O2, T-Mobile, Swisscom, everything everywhere in UK, AT&T. So these are just a few out of the 50 telcos we deal with. Vodafone is a company we have also developed a close relationship with. We made 2 small acquisitions last year, and now all Vodafone branded accessories you see across their Vodafone telco footprint in the world are accessories designed, developed, and manufactured and distributed by Strax. So we have also gathered a strong relationship with Vodafone, which is missing in this chart. And just recently, also 3 major telcos in Japan have recently been secured as customers of Strax. Now a little bit on the figures. We have seen good growth in the last few years, trailing 12-month revenue of, this is end of June, 98 million euros. And the growth has come out of multiple different markets. This year, most notably, we've seen phenomenal growth out of Americas, as well as the rest of the world. And the rest of the world under this umbrella means Middle East, South Africa, and Japan. And we expect these markets to continue to perform well. At the same time, our operating profits has risen quite notably. We have communicated to the market that we believe that our operating profit can continue to grow and outpace the growth of revenue by a factor of 2 to 3 for the next few quarters at least. And this is coming for 2 separate reasons. Why we see, and we call this a scalable growth model. Why this trend can continue. A is the infrastructure we have developed and built in Germany, where we have our centralized warehouse to support our European business, is now operating probably at 60% capacity, and we can increase that revenue without having to invest in infrastructure. And B, and equally important, is what I told you before, when we sell one of our brands into markets where we are not operating as a distributor, we immediately contribute to the operating profit line, the bulk of that increase in contribution margin coming from that additional sale. How we have, if you look at our margin improvements for the last 5 years, it's been quite significant. There's one reason behind it. It's the mix of products of own brands versus distributed brands. So what own brands does, your profit margin is probably twice to that of the brands you distribute. And B, and equally important, we take full control over the supply chain. So that's why this shift over to our own brands has been super important. We believe we can push the bar a little bit further on the ratio of own brands versus distributed brands. However, we also firmly believe that we can squeeze anywhere between 3 and 7% out of the supply chain, as well as our operating structure, to improve our margins going forward even further. Q2, this is still relevant news, but will be old news as of I believe the 28th of November, when we release our Q3 earnings. Sales growth in Q2 standalone 14%. The gross margin has also grown year on year, and the balance sheet or the leverage in the business is quite reasonable. Just a couple of words on the strategy. I'm not sure where we're on time. I want to go reasonably fast, but the key strategies you see in the center of the diamond, it's e-com. When I say e-com, and we've gone through, I would say, a significant analysis on how we become relevant in e-commerce, the idea is not to start investing in our own B2C websites or build and develop a B2B marketplace. We want to support our traditional brick and mortar retail customers with improving their online activities and sales, as well as be relevant on marketplaces. Marketplaces globally are the Yahoos and Amazons of the world, and that's how we intend to become relevant and competitive in the e-commerce space. Global expansion, that has already started, and I gave you a glimpse here. We believe that the revenue distribution geographically over the next 3 years will even out between Western Europe, America or North America, and rest of the world. Portfolio of brands, that's a given. We have to be on top of sort of the trends and what's going on, and every now and then take some small risk on where we believe the industry is going. I think we've been quite good at that in the last few years. Acquisitions, we are seeing on average anywhere between 3 and 5 acquisition opportunities a month. So the deal flow is quite strong. We are very stringent on what we want to acquire. Not only do we want to acquire it cheap, we want to deploy a very sort of heavy earn-out structure to align interest with sellers. And the last 2 acquisitions we have executed have been very highly earn-out based, with up to 90% of purchase price consideration paid through an earn-out vis-a-vis at completion of the transaction. So this is very important for us going forward, and then obviously it's a given that we have to be excellent operationally to sustain our profitability and even grow that going forward. Last slide, I think Strax, if you look at the industry and how we are positioned, I think we're in a very strong positions. There are competitors. You would not, if you would go online and try to find a direct peer to Strax, you could not find it. There's nobody out there with a distribution strategy along with a own proprietary product strategy. There are companies that call themselves a house of brands, but they're missing the distribution strategy. We believe this uniqueness of having access to channels and servicing them through distribution gives us advantage in many cases of servicing customers outside where we don't have distribution. We know the distribution landscape, we know the mindset, so we can overcome some of the obstacles that brands might have on a standalone basis to try to convince a local distributor to sell in. So we believe that's a pretty significant advantage we have. Another one is if you ask sort of what's Strax's competitive advantage, I briefly told you before that the telco telecom operator customer base we have is quite unique. And then at the end of the day, it comes down to the team. I believe we have a very strong team that's been in the industry for quite some time. And comparing our team to the many of our competitors, I believe we have one of the best accessory teams and teams now ready to take on the connected devices space in the industry.
Okay. Thank you, Gudmundur.
Thank you.
Any questions from the floor first? Nope. Okay. You're growing, still growing quite substantially. So would you see any challenges in this strong growth, or is it just positive?
I think there's competition out there, and we are continuously up against competitors, and we participate in tenders on a regular basis. We have been very successful in winning major tenders in the last 24 months, I would say, which have attributed to the growth. We are seeing the markets, most markets in Europe, sort of stagnate, and some of them even reducing volumes. You know, we see the value growth still going on. We are sort of ourselves investing heavily in the Americas. If you look at the Americas and compare that to Europe and the dynamics in the industry, Americas represent, North America, Canada, 35% of the accessory business globally. Europe is 11%. Europe or Western Europe is, by most definitions, 24 countries, 21 different languages, I think 17 or 18 currencies, whereas US is one market that's twice the size and much more. If you really hit it with the right proposition in the US, then the growth, the historical growth, will be small compared to the future growth.
The mobile manufacturers have, they've been launching more models faster and faster to compensate for the slowing growth. Is that a problem for you, or is it an opportunity? Because you have to adapt your products too in some parts.
Yeah, luckily, 2 out of the 3 categories are not dependent on the device type. So, audio is not dependent on the latest iPhone or the iPhone 5, for example. Power is the same. It's agnostic in terms of the type of device, and usually, with the exception of Apple, they have their own connector for the phones. There's a Lightning connector. Cases and protection, that's the most sensitive category. That represents roughly 30% of the global market. Historically, we have been very good at bringing products to market in time for the phone launch. I don't recall a single event where we have missed a launch in terms of time or in terms of we had the wrong form factor. So we have to sometimes make calculated bets. Apple, for example, doesn't announce a device and release it. That's a very short time span. We need to have started production way before they make an announcement. And we have, of course, our sources and various different factories that have access to what we believe is the right CAD design at any given time. And so far, we've been right. Mm-hmm.
I was thinking also that one of the things that are important for you is to catch the trends in the market, since it's pretty much selling accessories who are. How do you work to do that? How do you get the trends right? It seems to be working right now, but what's your future outlook?
We work with various different market research companies, both directly in our industry, as well as in the fashion industry and other sort of relevant industries. Fashion is becoming more and more important in our space. People not only want to protect their phones, they want to personalize them. That's why you have to be on top of the trends. So we are working with a number of different research companies. We attend, I would say, all of the major trade fairs that take place in the world, and then have our own scouts. We have close relationship with what you saw here, the licensing companies or the licensors. So we are dealing with Adidas, for example, and you can just imagine that they stay on pretty on top of the trends that are going on. And if we see something from there, we try to jump on and follow suit.
Okay, one question before we wrap up.
You had a slide with the total market being, if I remember correctly, 130 billion or so.
Yeah.
That means that you have less than 1% of the
Yeah.
total market. What could you realistically reach?
We have a 3 to 5 year target of going from the 100 million to 300 million, and we're still only scratching the surface. And we have sort of longer term aspirations. If we look 10 years into the future, which is very difficult to predict what's going to happen, we believe we can grow significantly, both through organic growth as well as acquisitions. But we sizable. If you look at the largest company in the industry, it's a U.S. brand called OtterBox. They only manufacture cases. They're 90% of their share is in the U.S. They did last year in excess of $1 billion in revenue. There are numerous other accessory players, brands that do somewhere between 100 and 200 million, but OtterBox by size is by far the largest. If you look at then some of the distributors in the space, you have a few distributors that are doing anywhere between 500 and $1 billion. I don't see why we shouldn't be able to compete in the Champions League, if you will.
Thank you. Thank you very much.
Thank you.
Let me just do one question out of personal interest. I'm your House of Brands mobile accessories biggest fan and the biggest asset, because my consumption is very unhealthy. And of course, I look forward to the iPhone X. I know they introduced 3.5 amps fast charging through USB-C, and also the cordless charging, where you just throw it on a mat and it charges without connecting a cable, just lies there. Is this an opportunity or a threat for you?
This is definitely an opportunity. If you think about the power category, if you go 6, 7 years back in the power category, when the European Union announced that they would standardize a connector for all phones, and everybody said the power category is dead. People will use their charger over and over again. They're going to go through 5 different phones and have the same charger. This has been the fastest growing category, is power, since 2010. And now with wireless charging has been around for 3.5 years. Samsung has been offering it in their devices for 2 years. But finally, when Apple jumps on the bandwagon, we've seen the market just take off like a rocket. And that's definitely an opportunity for us, both within our proprietary brands as well as the partner brands we have. And that's the next evolution is you're going to have true wireless, because now you have to charge the charging pad. Eventually, you're going to have small transistors where you charge and just walk in a room and your phone is charged. Then we have a challenge.
Okay, thank you very much.
That's 10 years away, though.
Thank you, Gilbert.